There is anything that is going to kill inflation, it is the rising price of oil. I know I've been feeling it myself at the pumps. And what we're going to do in this video is we're going to discuss how we got here today in terms of why oil is expensive. We'll talk about what has happened in the past, the history of high oil prices and what it does to the economy. And then we'll talk a little bit about where we go ahead in the future, what the future has in store. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new or you get some value out of the video, hit that like button for me. I definitely appreciate that. And if you haven't already, please consider hitting the subscribe button and turning the notification bell on for content similar to this. We're going to jump into the computer here, looking at the World Economic Forum, an article here talking a little bit about how we've gotten here today in terms of why oil is so expensive. So the first portion is the booming economic growth is driving demand for oil. So we shut the economy down in March of 2020, and then we've started to open up and ramp up over these past couple years. And that's putting upwards pressure on, people needing oil, gasoline, jet fuel, diesel for trucks. As we opened up the economy here, there's been just a massive demand for the commodity. The second portion is the limited supply of oil due to long investment cycles and cautious capital allocation. So we've talked about this before in the past. In Canada, the investment into oil really stopped in 2015. We really stopped investing in our oil sands because obviously the long-term goal is to stop using oil and transition into more renewable energy. So because of this fact, and because of shutting down in 2020, a lot of these oil producers really cut labor. They weren't manufacturing as much because they weren't really sure as to what the future had in store for that demand component. So we have a lack of supply and we have high demand, and that is a perfect equation for prices going higher. We also have the third point here, which is the geopolitical tension. So that is obviously the situation that's happening in Russia and Ukraine. Major manufacturers, producers of oil supply into the European market. This has investors worried about that supply component of the equation. So that's how we got here today in terms of why oil prices are so expensive, why we're feeling it so much at the pump. But we're going to be discussing a little bit about what the higher oil prices have in common, or what is their purpose when it comes to the economy. So many people don't realize that oil is really the underlying sense of the older economy. The production of goods needs oil. The transportation of goods needs oil. There's so many different components of hard goods in which you own, which need oil. And as those prices continue to rise, it really doesn't help inflation. It actually would exacerbate the problem. It would actually make inflation higher. If it costs you more to get the goods from your warehouse into the distributor or into the retailer, like an Amazon or a Walmart warehouse, your price of the goods are going to go up. You're going to push that onto the consumer. So we'll take a look at what the after effects are for the economy if oil prices stay high for a long time, or even where they're at today. Oil price increases can also stifle the growth of the economy through their effect on the supply and demand for goods other than oil. Increases in oil prices can depress the supply of other goods because they can increase the cost of producing them. So just like we said, if the price to produce these goods goes up, then they'll push that cost to the end consumer. And the end consumer, you and I will have to think long and hard, is this price increase worth buying it? So if we start to see multiple things have increased prices, then the economy will eventually slow down. So that's what we talk about at the beginning, to say, okay, this is the way that we kill inflation, is by actually ruining demand. We're going to kill consumer demand because we're not going to be able to afford these goods anymore. So we're going to take a look right now at what has happened in the past, but we can definitely say that despite these effects on supply and demand, the correlation between oil price increases and economic downturns in the US is not perfect. Not every sizable oil price increase has been followed by a recession. However, 5 of the last 7 US recessions were preceded by considerable increases in oil prices. So, the last 5 of 7 prior to 2007, because that's when this article or this researcher Sill had looked into it. We'll take a quick peek at that specific report and to see what the overall conclusion is. So there was an important fact that I found in this article. It said the empirical evidence suggests that a 10% increase in the price of oil is associated with a 1.4% drop in the level of US real GDP. So we've seen oil prices go up 30 or 40% within the last couple months ever since these geopolitical events started to occur. So we could actually see a recession on the horizon. I think that's kind of reflected in the stock market today of what people are pricing in. We're in a real sticky situation. We're in a situation where we have inflation running out of control. We have high oil prices, and then we have a government that is actually going into a tightening situation. They're raising the interest rate, which is making money more expensive to get. They're actually stopping the printing. So we're kind of in a sticky situation as to how we get out. Since 1999, there has been a dramatic increase in the world price of oil. The evidence suggests that this increase is not so much driven by supply disruptions as for strong demand. So we're starting to see a lot of these secondary economies like Asia and China, India, start to have population growth. So their demand for oil is actually increasing. So it's not so much a supply side, but more of a demand side for the rest of the world. For the US specifically, some of this price increase is tantamount to an external oil shock. However, because the rise in price has been gradual and has occurred in the face of strong growth, the US economy has not experienced an oil-induced recession. Nevertheless, the evidence suggests that the recent rise in oil prices has worked to restrain domestic output growth. We do see a little bit of contradictory statements here. What we're actually seeing is the fact that it's not a supply side shock. It's actually that prices are raising so much that people can't afford them anymore, and that's basically killing inflation because people just won't buy anymore. So I think that's the underlying statement as to what is trying to be made there. This data goes back 2007. So let's take a look at something that's a little bit more recent. This is the US gas prices specifically. And we can see the red sections on the graph here are when certain crises or recessions happened in the economy or stock market. So we have the dot-com crisis. We don't see too much of an increase of oil there, but we fast forward to the Great Recession, and oil was definitely the key indicator as to when the economy started to fall. So we could see there that there's definitely a direct correlation. But as we fast forward to this recent, COVID collapse, there's not so much of an increase of gas prices. We definitely see them moving upwards. Today, February 28th, $3.61 per gallon in the US, which is super expensive. So that's where we're at today. We'll be specifically talking a little bit about diesel right now. And diesel is super high right now. We'll take a look at this chart. This is the US retail diesel price. And we can see here that over this 5-year span, it has gone up, 3x, 4x. As to where it traditionally sets. Now, where diesel is so important is that this is what trucks use to move goods into stores. It moves groceries into your local grocery store. And if the price to move goods again is going up, then we're definitely going to see continued inflation in the short run. But what you could expect over the long run, and this is what I'm thinking, is that this higher inflation will kill consumer demand. We will actually see people start to slow down on what they're spending for goods, and it could actually hurt the economy and what could inevitably be a recession that is going to be extremely challenging because of the fact that inflation is hitting 40-year highs. You have a Fed that is going through a tightening. So we're not only is the economy going to hurt because money is expensive to go and loan, but we're also seeing the price of goods go up. It doesn't look like the best situation. I mean, I want to be as positive as possible, but we're kind of going through a very sticky time right now. Money was so free flowing over the past 2 years. Now we're really in a situation where we have to figure out a way to come out of this, and we might have to go through some pain for some while. So let me know what your thoughts are. Do you think the high oil prices will kill the inflation that's going on? Not necessarily a great thing, but definitely one of the only ways that we can kind of get out of this scenario. But if you're still here with me, hit that like button. I definitely appreciate that. Hit that subscribe button. I hope you all have a great week in the markets. Happy trading.